Mark-to-market or MTM refers to an accounting practice under which the value of an asset is derived from its market price and not the price at which the asset was purchased. Till the time the asset is sold, movement in the price of the asset will therefore result in either a notional loss or a notional gain. Indian banks are large holders of government securities as the banking system has to maintain a statutory liquidity ratio or SLR. SLR, which is a percentage of deposits, is primarily maintained through investment in government bonds. The current requirement is 18% of net demand and time liabilities. Banks run an interest rate risk on these bond investments. When benchmark policy interest rates rise, bond yields also rise because of an increase in the cost of funds. Bond prices and yields move inversely, which means that when yields are heading higher, banks face MTM losses on their bond investments. Banks need to make provisions for these losses, and this threatens profitability. For example, a rise of 1 basis point in the yield of the 10-year benchmark government bond corresponds to a fall in the price of roughly 7 paise. In the June quarter, the yield on the 10-year bond rose by 61 basis points to 7.45%. Banks do have protection from interest rate risk in the form of a bond portfolio called the held-to-maturity portfolio. Securities kept in this portfolio do not have to be marked to market. The RBI has been increasing the limit on HTM portfolios in order to provide banks with a cushion from MTM losses amid a very large supply of bonds by the government. The other two portfolios are the available for sale book or the AFS book and the held for trading book or the HFT book. These two portfolios are marked to market and hence are at risk of losses in the current environment. Securities from the AFS book can be sold at any time, while those in the HFT book must be sold within 90 days. As of June 18, 2022, banks' investments in government securities stood at 49.5 trillion versus 45.8 trillion a year ago. The pace at which banks have bought government securities over the last 2 years has outstripped the mandatory requirement under SLR. This is because the ultra-loose monetary policy maintained during the pandemic provided banks with the opportunity to make gains out of bond investments as yields fell. Now, with the rate cycle turning, banks face large MTM losses on these bond holdings.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.